Moving averages. Moving averages are important indicators used to analyze price movement and trend direction. Moving averages are simply the average of the closing price of a trading security over a given period of time. They are used to understand price action during a specific period of time in order to identify the overall trends. Because they are based on past price action, moving averages are considered lagging indicators. There are two types of moving averages that are generally used by traders and investors: simple moving averages, SMA, and exponential moving averages, EMA. How to use multiple moving averages. Moving averages are the trading indicator used for signaling trend continuation and trend reversals. They are oftentimes used as support and resistance indicators. Moving averages act as price magnets. The farther away price moves from the moving average, or a group of moving averages, the higher the chances that price will try to move back closer to that moving average or group of moving averages. Traders and investors watch specific moving averages to see how price reacts when it reaches them. Different trading styles require the use of different moving averages. Short-term traders watch short-term moving averages, 3-day, 8-day, 15 days. Position traders and investors watch intermediate and long-term moving averages, 50-day, 100-day, 200-day. Whether you are a day trader, a swing trader, a position trader, or an investor, there are 5 moving averages we highly recommend using. The 200 simple moving average, the red line, the 50 simple moving average, the blue line, the 21 simple moving average, the gray line, the 8 exponential moving average, the orange line, and the 34 exponential moving average, the purple line. Okay, so this is a quick video to explain how stochastic works in the oversold and overbought conditions. So oversold, it's reached down near the bottom when price crosses, you see this brown line, this is 20. 20, the green line here, it's 80. So those are the areas where when this indicator called stochastics reaches into and above the green line, 80, this is considered overbought, means prices reached a high enough point where investors and traders are taking profits. And the opposite is also true. When price reaches down below the 20, this is the brown line, and reaches into the 10 and zeros, that's when things become oversold. So price reached a bottom, and investors and traders now like the new price and are willing to step back in. So by looking at the oscillator stochastics, we are able to identify when something is being oversold and overbought. Now that's not an indicator you want to use on your own. Like most indicators, you want to use them in conjunction with what the chart is telling you in terms of price action and volume. So, for example, we are seeing in this area, those lines are the upper lines are resistance, the lower lines are support. Yes? So those lines, I draw them based on historical data looking back months and years ago. So we know that historically there is some resistance up here at this line, which is 619, and this line 665. So as price gains some momentum, bullish momentum, and reaches the resistance, you should expect price to pull back a little bit. So this is a place where we can start closing the position, partially or fully, or looking to exit the position. So you got a couple of indicators right here going on. You have a big red candle showing up right after the uptrend. So this is an uptrend. And then you got a big red candle. This is almost a bearish engulfing, so this is a sell signal. You also have the indicators. You see the red line and the blue line. The red line is crossing over. That's the one that moves slower, and the blue line is the one that moves faster. So when those two lines cross over and they start rolling down, this is telling us the stock is in an overbought condition and expect a pullback or a downtrend. So that's when you see this indicator moving down, you see a sell signal, you see resistance, so then you put all these factors together and you make a decision to close the position. So then you close the position. And then when do you re-enter? So you re-enter at support. So we have support here. There is a trend line right here, middle of the channel. So there is a channel. This is the top of the channel. This is the bottom of the channel. This is the middle. Middle is oftentimes an area of support and resistance. In this case, right here, it's acting as support. And then the following day, acted as resistance. So before you enter at support, you want to make sure there is a buy signal. So you're still seeing a red candle. So this tells us price is still going to move lower. And stochastic right here on this day, you see, it continues to move lower. And then there is another area of support right here. So you expect as support price to slow down, or pause and hold, and then start moving higher. Right here, it's where we see price getting into oversold conditions. However, still we are not seeing any bullish reversal signal. This could have been a day where you see this hammer. But then it didn't get a follow through. This was a little green, but then another candle. The support did not come until this day. A little bit here, but this was the day when support was confirmed and price started moving up. It was also confirmed by the stochastics moving up. And there. And then more confirmation here. So it crosses over and then continues higher. And then price moved above the support and then moved higher. So that's how we can use the overbought and oversold conditions using stochastics, as well as areas of support, resistance, and trend lines. And then moving forward, we have a couple of more examples. This is currently happening. Then we have right here, so same thing going on. Price found the bottom and came up, found the bottom and went up, find the resistance, same resistance as here, and so you expect price to roll over. And then here you see stochastic is in overbought conditions again, above 80, and then right here they start rolling down, you see a red signal, and then things begin to flag. This is a technical formation, a consolidation pattern. Price come down, come all the way down to the 8 to the 20, this is the oversold condition, and then what happens right there? You have a buy signal right at the support again, just like it happened here, and this buy signal was a harami, followed through by a breakout of the flag. Break out the flag with volume, and there, and stochastics start moving up. So from overbought, the lines crossed over and went up. Now we are into a new phase, so we are at the top of the channel, and stochastics looks like they're starting to rolling down. So that's how you use stochastics for overbought and oversold conditions. Please note the stochastics indicator does not work for momentum trading, only for trending stocks, not momentum. So this is a trending stock. We see it's moving up and pull back. It's moving up and pull back. It's moving up and pull back. Okay? So this is a trending stock. A momentum is something that skyrockets. See this company right here? This isn't a momentum. It just continues to move higher. You see what the stochastic does? It doesn't roll down. It stays up here, stuck in the overbought conditions. See? So remember, stochastics only work for trending stocks, not momentum stocks.